Good afternoon. This is Benjamin Thorpe, Associate Research Editor of Ag Equipment Intelligence. Welcome to our latest webinar, Opportunities in the Changing Economy. 2020 has held more than a few challenges for farm equipment dealers and manufacturers. The effects of the COVID-19 pandemic, coupled with trade issues and corporate OEM restructuring, have hit dealers with a steady stream of both challenges and opportunities. Some of them include falling corn and ethanol prices, increased demand for rental fleet offerings, and one of the oldest agricultural fleets in the field on record. To help dealers not just survive, but thrive in these situations, this webinar will explore how dealers and others in the ag equipment space can expect to be impacted and what opportunities they can take advantage of in this rapidly changing economy. Today's webinar is sponsored and presented by Coe Isom. The firm, which has been serving the food and agriculture industry since 1932, is a national consulting and top 100 accounting firm. Its locations span the U.S. from coast to coast and comprise of industry experts who solve business challenges from policy to plate. Today's presenters are industry champions and team leads Marc Johnson and Clinton Baker. Both are Coe principals. Now, before they get started with today's presentation, we have a couple housekeeping items to share with you. On your screen, there's a control panel with a Q&A icon. You can submit questions here at any time during the presentation. Time permitting, we will try to answer as many questions as possible following the presentation. If for any reason you lose your internet connection, or if our internet connection should happen to fail, and it seems like the webinar has been interrupted, you can go back to the email you received earlier telling you how to join the webinar, and you can re-enter it that way. Okay, looks like we are ready to get started. Thank you again for joining us today. Now I'll turn it over to Marc and Clinton.
All right, well, thank you, Ben. As introduced, my name is Clinton Baker, and I'm a partner in our firm's office in Indianapolis. And I'm joined today by my colleague who I'm on the road with a lot before we had COVID-19 outbreaks all over the country, Marc Johnson. Marc is our firm's market champion, as we call him, which means he heads up our equipment dealership team out of our Kansas City office. And Marc and I travel the country working with about a little over 40 heavy equipment dealers now, obviously talking with dozens more. And if you see the picture on the screen here of Marc from a video shot from last year versus the person you see on video with me, it is the same person. Marc's done a great job capitalizing on the quarantine, working out and eating a little differently, and proud of Marc. He has used that time better than I have, but it is the same person. They both look like Drew Carey at different phases of life. Anyway, Marc and I have been working with equipment dealers really for over 25 years, which seems hard to believe. Time's been flying, I'll word it that way. But we've been with a lot of dealers through the decades as economic times have at times beaten down dealerships' performance, and at other times, really buoyed it and created a lot of opportunity. And 2020 is a year that I think will go down in the history books as one that was best summarized as disruption. And we're going to talk about that a little bit more later on. But we've still had a lot of calls from dealers about potential mergers and acquisitions or about buying partners out. Marc and I speak on M&A a lot. Many of you on the call today have probably heard us speak on that. We've also spoken about PPP, Paycheck Protection Program, a lot this year. Many of you may have heard that as well. But today we're going to take a turn in a bit of a different direction. And so, Marc, share. I know you've pulled some headlines that have really inspired today's conversation between us and Ag Equipment Intelligence in their webinar series. And what are some of the things that have caught your eye?
Yeah, these are just a few. So, we're going to approach the economic and performance issues that Clinton just referred to from the perspective of the opportunities and challenges that come up in a year of disruption like this, or the current economic client, if that sounds a little more positive. So just looking at some of these headlines, you see we got most of the large OEMs had some headline or other in the last 3 or 4 months about reorganizing or retooling or doing some replanning, certainly some layoffs and some closures of factories and things like that. But these reorganization ones caught our eyes, and it also caught Dave Kanicki's eye at Ag Intelligence, and he had called Clinton and I and said, as CPAs and consultants, should dealerships be thinking about reorganizing as well? It caught me off guard a little bit when he asked it, because when I think of reorganizing, as a CPA, I think of the bad stuff, like some of these above, like the Briggs and Stratton bankruptcy, for instance. That's a reorganization that hopefully gets them back on a plane that they can operate from. But other times under reorganization, as we're looking at it for our clients, it might be around tax planning, whether that's they are currently a C corporation and they're tired of paying taxes on dividends. They want to be a pass-through, or they're currently a pass-through, an S corp or an LLC that is paying either some high self-employment tax, or they don't like the way some taxes are going and those kind of things. And so there might be some reorganization that we do to take advantage of taxes. Same with if there's a retirement or succession planning going on, there's some reorganization tools that we often use to just get the company or the entity structure such that we can operate a little bit differently to get cash where we want it and to get ownership where we want it, that kind of thing. Oftentimes, we also are talking about reorganizations to take advantage of some programs, government programs or other programs that might benefit it. It was kind of interesting earlier this year when all the PPP stuff was going on. We had a lot of the large dealers call us and say, I got more than 500 employees. What happens if I turn myself into 4 or 5 different organizations and get under 500 employees? Unfortunately for them, it was too late at that point because it was past February 15th, which was the magic date for a lot of that. So we couldn't reorganize, but oftentimes we do. Clinton said, I think he mentioned earlier, he's going to hear in a little bit, a lot of our clients in the firm are producers. And so oftentimes they're looking at reorganization to take advantage of government program payments on the farm and things like that. So that's oftentimes what we're talking about when we're thinking restructuring. But for today, we're talking about it in a little bit different light. Today, we want to talk about it more on, given what we've got going on, are there ways that we ought to operate differently to take advantage of some opportunities or to avoid some challenges that might be heading our way because of the economics? As those headlines showed, the OEMs, they've reacted to those challenges and opportunities with the reorganizations. Some of those were big. You saw some bankruptcy and some sales of divisions and things like that. So some of those are really big. Others are harder to understand how big they might be. Like they used words like unlocking customer value and technology shifts and things like those. Sometimes those are buzzwords that sound a lot bigger than they are, and sometimes they're buzzwords for masking something that's a lot bigger than they want you to understand what that looks like. But regardless, there's several different kinds of reorganizations that went there. We're going to talk again more about the opportunities and challenges. So we're going to talk about things like falling corn and ethanol prices, rental fleet change, demands changing, impact on sales mix and precision ag demand and things like that. So we're going to talk about what we've seen some of our dealers doing or facing this year. And then hopefully at the end, Clint and I don't get too long-winded to have time for questions and answers. So prior to that, I guess Clinton's going to spend just a half a second here, maybe a minute, just making sure for those of you that don't know us, to give a little credibility, just so you know, are these guys, they know what they're talking about enough for me to pay attention for the next hour?
That's right. That's exactly right. Thank you, Mark. So this is a quick slide. Again, if you have attended Mark or my presentations before, you have probably seen this slide. Several graphics. These are all graphics about our firm, Coe Isom. We've been around almost 90 years at this point. We'll be celebrating 90 years here in a couple of years. 2/3 of our firm's practice is in the food and ag industry. In fact, Ben in his introduction used a phrase that we use a lot, and that is we have influence on the food and ag industry from policy to plate, literally from our Washington, D.C. office, where our lobbyists are for the food and agriculture industry, all the way through the eventual consumption of food and agriculture products. Oftentimes it's clearly in the food side, but there's also an energy aspect to it. We're going to talk about ethanol here a little bit later as being one of those. You can see, I'll point out the map on the next screen, but you can see some other things about our firm. On the next screen, it speaks a little bit more specifically about our dealership practice. So if most of our firm works with ag producers or someone in the supply chain from policy to plate, Mark and I would be somewhere in that supply chain on the side of equipment dealers. We work with a little over 40 equipment dealers across the U.S. Most of them are going to be ag dealers, but there are some construction dealers we work with as well. You can see on the map on this slide here, the states that are colored green are where our firm has physical locations, where we have offices. the states that have a green tractor on them doesn't mean they're a John Deere dealer, but it does mean we have clients in those with locations in those states that are ag dealers. And the states that have a yellow dozer, again, doesn't necessarily mean they're Caterpillar or John Deere or anyone else that has yellow construction equipment, but it means we have construction equipment dealers with locations in those states. I'll let you read the list, kind of just a list of services. Again, a lot of people ask us, well, what all do you do? You're accountants and the mysterious word consultants. This is just kind of a list of many of the things we do, but probably the more relevant point is right there in the middle on the bottom. When we look at our practice, a little less than half of our practice comes from auditing dealerships, doing reviewed financials, that sort of thing. Most of those are going to be audit. About a fourth of it comes from our tax practice, and roughly a third of it comes from consulting, doing many of these other types of things, whether that's helping them find additional capital, whether that's an M&A transaction, or helping them with PPP loans, those sorts of things. It's also exciting, Mark. I do notice that it'd be too big of a map, but our firm recently announced a joint venture with 4 firms in Australia. And so it's exciting for us to really begin to expand outside of just North America. So that's exciting. But, enough about us. On the next slide here, when we think about 2020, I've heard it said for most people, 2020 is an economic year that we just want to get behind us, Mark. It isn't, it's for some people, it's been a good year. For some people, it's been a bad year. For a lot of people, it's been an uncertain year. And so I like rule number 1 there from Marty McFly and Doc, I can't remember Doc's name, but from Back to the Future here, rule number 1, never set it to 2020. And I think that's the sentiment of a lot of business owners and executives like the people on the call today. We knew coming into 2020, we were coming into an election year. We knew that would have a very significant impact on the economic results for equipment dealers, especially, as it relates to were we going to get an update on a farm bill? Were we going to get an update on an infrastructure plan? And I know most people on the call today are probably agriculture dealers, but even at that, if the construction guys get some type of boost, clearly it's going to take OEM resources and allocate to that direction to make those kinds of machines, which impacts ag as well. But really, Mark and I looked back and we actually did a webinar for Ag Equipment Intelligence last November, talking about 2020 being the year of a turnaround for dealers. And Mark and I kind of laughed. We were like, I hope no one on the call today goes back and reconciles that presentation. That was pre-COVID. Mark and I had no idea what was coming either. But as we've, in 2019, we had seen rising profits and rising sales. The age of the fleet seemed to make 2020 a year for the breakout. And of course, then COVID-19 happened. And since then, many of the discussions have been around PPP programs and Main Street lending. And, next thing you know, we're throwing trillions here and trillions there. Next thing you know, Mark, you and I are talking real money. Kind of like when you and I travel together and we bet in billions, which I'm pretty sure you owe me, but we're going to move on. But, we were also looking at stock markets looking up. In fact, I was looking earlier today at one of my investment accounts, and it's one that it's not one I trade with. It's one I just put some money in about a year ago in 2019. It was interesting to watch it go up and, of course, take the tank down in March. But all of a sudden I look, and here we are at the end of July, and I'm back up almost on the trajectory it was even before March, which is an exciting thing. So I think generally in the economy, there's still just a lot of disruption. And so a couple of things on this slide here, there at the bottom, two things happening next week I wanted to point everybody's attention to. One of those is our firm is having what we call a Pro Summit. It's a 2-day virtual trade show, and it's really about disruption. And it's somewhat industry agnostic, although all the industries are going to be food and ag related. It's something that for those people that are on the call today, I mean, clearly you are friends of Ag Equipment Intelligence, which makes you friends of ours. You'd be invited to come to that. But also next week, Ag Equipment Intelligence has a trade show as well about, how do you turn profit turning trades is the title of that. And again, kind of the same thing of how do we take advantage of these opportunities that exist today. And so what we're encouraging people to do is, rule number 1, never set it to 2020 and go back to 2020. But while you're here in 2020, living in the present, there are still opportunities for places to get resources and to get ideas and to get really a leg up on how do we finish 2020 as best we can and be poised to deal with this disruption. And so, Marc, when we talk about on the next slide here, when we talk about the changing economy, you've got several slides here to walk us through some of the key metrics that we look at when we think about specifically ag equipment dealers and how this economy is challenging them.
Right. Well, last week when I was kind of preparing for today's session, because the topic today is a little more broad than normal for us. Typically we're talking about mergers and acquisitions or valuations or a specific part of performance. Well, today's a little bit broader about economy and where do we go. So I was visiting with Chris Haverkamp. He works with our producer base in one of our divisions called Paragon Investments. Obviously, Chris makes his money and now makes money for us when there's a lot of volatility. In fairness, he's making money for the producers as well when there's a lot of volatility to try to shave the edges, off of that volatility, so producers can market their grain at the best possible price that makes sense for them. I think Chris actually looks forward to years like this when there's a lot of volatility. But what you can see in this graph, the reason I wanted to make sure we talked about it is because throughout history, you go back, and it's one of the cleanest predictor models I've ever seen in any industry. And that is basically following corn prices, because they have so much to do with the ag producer index. Following corn prices, you can pretty much parallel line that with the sale of equipment. And so obviously we saw corn prices tank this year. And so that had us extremely scared about stuff. So as you see in these graphs, the corn prices, they got particularly hit hard this year when the stay-at-home orders came up. Stay-at-home orders produced people not driving back and forth to work or to see clients or to travel. And so all of a sudden there's a glut in oil. One of my favorite pictures so far of COVID was actually there's two of them. One is the Kansas City Airport here in Kansas City. Delta is not a hub here, but evidently we have a cheap parking lot. So Delta parked about 150 airplanes, and most of them are still parked out there on 2 closed runways. None of them have gas in them, and so they're just sitting there, not using the gas that they would use. Another picture I saw was about 35 oil tankers off the coast of California, just waiting to be able to dock because there was nowhere to put the oil had they docked. And so things like that produced a glut in oil. Well, obviously, ethanol prices, or ethanol, is a big part of the consumption of oil by the time it gets to us. And so when we cut oil, we cut ethanol, and we cut ethanol that much, and all of a sudden corn prices have to respond drastically. In fact, they changed so drastically this year that it was the first time that I really noticed that they diverged away from the wheat prices. So you can see in that top left graph there that the corn prices obviously is the orange one that continues to go down. The wheat prices actually looked at that and said, hey, I'm not in ethanol. So they continued actually, they've actually had a little bit of some rises in there. And so, but anyway, corn prices have had a lot of change in there, which is interesting to think about because this is hard to remember, but you don't have to go back that far. 12 to 15 years, and there wasn't any ethanol. Then we ramp up ethanol production. All of a sudden, it was using 35 to 40% of the corn production that was out there. So much so that Iowa, of all places, had to import corn at the height of the ethanol market. Now we're in a time that not only COVID interrupted that, but we're also coming out of COVID, where we're having different energy sources that had already started to make an impact, might make even more of an impact heading out of this, whether that's the traditional solar, wind, and that kind of thing, or if it's other sources that we don't even know about because people are at home and use their imagination while they're at home to come up with something else that might hit the market at some day soon. So we don't know really what's going to happen long-term wise with ethanol. But again, if ethanol goes down and we all of a sudden have a lot of corn that's not going to make ethanol, add to that the fact that Clinton made the comment that I lost a bunch of weight. One of the things I did not eat in the last 3 months was high fructose corn syrup. And so that's another, we've kind of forgotten about that, but that was a big kick a while back too. And so corn has kind of taken a beating in there, and that's why corn prices are where they're at. The graph on the bottom shows what I was talking about. The blue line there is revenue from selling farm equipment. The green line that's kind of dotted right there in the middle is the agricultural price index. And that's the agricultural price index, but really if you look deeply into that, it's heavily influenced by corn. It's the biggest market in there. The red line, interesting on the top, is access to credit. And so what we see there is the green and the blue lines follow each other pretty well, except for they're in 15 and 16, where we like to always think about how bad the farm equipment market was. It actually wasn't as bad as the corn market. As you can see there, the green line dropped well steeper, but also rose steeper than the farm equipment. In 2020, the farm equipment did go down some. The one thing you have to be careful about that is when we're talking to our producers, we don't see that. This is a global number. And so globally, I think the farm equipment did make that. The other thing is a lot of what we call farm equipment sold at a farm equipment dealership is not necessarily farm equipment. So a lot of the sales that we've seen this year were turf, smaller ag equipment, the ancillary stuff, and a lot of parts and service. And so that would not be reflected in the sale of farm equipment in there. Unfortunately, the prognostications going out past 2020, that report was created in May, prognostications don't look all that sexy for corn either. It continues to be flat at best, and we're seeing kind of 2 to 3% maybe increases in farm equipment sales going forward based on that. The good news, though, from Chris at Paragon, so circle back to that, corn prices should only move sideways through next spring's planting because all the threats of production are already baked in. Unless something really bad would happen in the big markets, that there'd be no yield, which would be hard to imagine at this point. All that production risk has really kind of been baked into the prices already. So the only thing that is going to make prices drastically not go sideways, up or down, are outside sources. So some of the threats on that would be, are the reactions to the trade changes made earlier this year, are they good or bad? If they're bad, that could harm exports and things like that. The election obviously is a big deal. Take out politics for a second, which you can't, but we won't even talk about who we want to win or who we want to not win. But the election itself, someone's going to win and someone's going to lose, and that's going to disrupt the market on one side or the other for whatever reason they believe that it should. China, we can't ignore China. They're the ultimate disruptor, I think, as far as markets go, and certainly here. The opportunities are maybe at some point the US dollar decreases in value, which is always, you always have to say, why would I want that? But then you go back to economics and remember that the US dollar is so strong, it is impacting everything. So dollar goes down, everything gets a little bit better on commodity prices, as well as so on the flip side of the policy, if the trade policies have good reactions and that increases trade, then that's an opportunity there. The professional traders right now, they're at a record net short on corn, so they all think that corn is going down, the US dollar is going to continue to rise. You can see that gold prices are surging for the first time ever, and that's probably because, like Clint mentioned his stock account earlier, I stopped. I got tired of watching my gold do nothing and got out of it, and now I'm wishing I was back in it because gold prices are surging. So that's a little bit about the market, right now and why it's impacting things. The market, though, is not always the best predictor. This here we see the experts at Purdue, and when I talk about the experts at Purdue, I'm not talking about the professors. I'm talking about the producers that the professors at Purdue interview. And so every month they put together their ag economy barometer and the various reports that go with it. And you can see here that while those did take some big dips during the height of the corona scare, they've been kind of working themselves out nicely out of that. So you see the overall barometer there on the left. And in June, it had a nice rebound up to 117. And for those of you that have not looked at these reports before, anything over 100 means that the people interviewed think that the future looks better than the present. So we're going to see some increases in the market. The producers are going to make more money, have more cash in their pocket, like those kind of things. So 117 is a lot better than the 99 that it was down to in its low in May. But 117 isn't bad at all. So we're encouraged by that. We're also encouraged by the rise that we see in the Farm Capital Investment Index, which is on the top right. And essentially the question there is asking farmers, based on how things are going right now, what's your appetite for spending money? And spending big money, not like fertilizer and crop inputs, but capital investments, buying another farm or buying, importantly to us, more equipment. And you can see that number, whatever reason, it's always a little bit lower than we would like to see it. Part of that is the farmer not wanting to tip his hand because they are convinced that you guys are out there looking at these reports, and if you find out that they're doing well or they think things are going well, then you're going to increase the cost of equipment. So those numbers are always a little bit lower, but what you see here is that there was a nice rebound in June that 50 to 60 might not sound like that much to you, but that's 20%. That's 20% increase in their thought process towards spending money, and particularly spending money at your dealership. So that's a great thing. And the slide is similar to that below on the plans for machinery purchases. Take out, so it dives into that top graph just a little bit more and says, just on machinery purchases, what are people thinking about doing? Again, that goes the higher, the people say they're more likely to buy than were in May. Again, it looks like a small number from 4 to 6. Do the math on that. That's a 50% increase in the thought process about buying machinery. So we're pretty encouraged about those signs, even though we might be kind of discouraged about the actual economics that we've seen elsewhere. And then finally, that's shown here. These are actual results from dealers this year, and you can see they're actually pretty, if you go from the 19 to 20 on each one of them, obviously in the under 40 horsepower tractors, those had the nicest increases from 19 to 20 there. And these are year-to-date. The blue lines are year-to-date numbers. The 40 to 100 horsepower also had a pretty nice increase, and the rest of them were flat. Well, a year like this, we're pretty happy about flat because it's not down. So with all that said, about the economy, the interest rates are at an all-time low. The farmers came out of 19 with a lot of cash in their pocket. The COVID subsidies that the rest of us might have got through PPP or through the $1,200 that went out to all the people that made them buy lawnmowers for the past 3 or 4 months, that really hasn't got to the farmer that much yet. So to the extent that the COVID relief money is going to hit the farmers, we're going to see that more in the fall, towards harvest and marketing of the grain and things like that. So for the dealerships right now, based on what we've seen, in actuality, for the first few months, not too overly concerned about those downside risks. Back to Chris Haverkamp, again, he doesn't work with a lot of dealerships. He works with a lot of producers, and his quote to me was, I feel like the dealerships are just going to have to chop wood and get through it. Not exactly sure what he meant by chopping wood, but I assume what he meant was we just need to grind it out, do the right things, and there are still some sales that are going to happen.
I had not heard that expression from Chris, Mark. I would remind him that he lives in Kansas, and I used to live in Kansas, so I can say this. There aren't a lot of trees in Kansas, right?
We chopped it down hundreds of years ago to plant wheat, right?
That's right. That's exactly right. So on this next slide, I want to share this with everyone today. This is the actual dealership data from the group of dealers that Mark and I work with here at Coe. Again, it's about 40 of them scattered across the entire geography of the United States, as you saw on the map. The top part of this chart, though, one of the questions that Dave had posed to us when we were talking about this webinar was, how is the sales mix changing due to the economy? And this is something Mark and I have been tracking for a while. In fact, you can see in 2014, if you look at that bar on the far left, on the very top of that, service is in yellow and parts are in green. And if we add those two together, that's about 18.5% to 19%. And if you watch that just kind of sliding to your right, you can get over there to 2019, which is the second from right column, and you'll notice that number has gradually grown to about 25 and a half, almost 26%. And so there's a real shift that has happened in the last 5 years. Mark's going to talk here in a little bit about the age of the fleet and how that has been trending. But this is a trend that has been going on for a while. Now, the good news is when we look down at the bottom part of this chart, again, this is from actual data from audited financials of dealers we work with. The new margin, the blue line, the used margin, the orange line, and the red margin, the whole goods margin, all of that is charted on the left. And you can see those three have moved rather in sync, with a peaking out in 2018, gave a little bit back in 19, but is starting to trend up again when we look at rolling 12s through the first quarter of 2020. But you notice the other three lines look much more stable. Now they're charted on the right side of the chart on the bigger percentages, and that is the parts margin, the service margin, and then of course total margin. And so one of the things that we've clearly noticed as a changing in the economy and the sales mix over the last several years is this shift more to parts and service, which has led to a higher overall margin. In fact, if you look at the very bright yellow line, is total margin. It's charted against the numbers on the right side of the chart. So we see in 2014 that total margin was about 11%. Now, I know 2014 was hopefully for most dealers, the bottom of a trough. Maybe 2015 was a bottom, but they'd come off of 2012, 2013 being highs. And so in 2014, an 11% margin meant in many cases their net income would have been negative, only because their operating expenses were probably in the low to mid-teens would be the average. But as we've seen margins improve, clearly we've also seen sales dollars increase. The percentage has risen, and we're still, we haven't cracked 20 yet. We have some dealers that do, and their total margin would be at 20% or even maybe a little above. But the average is somewhere in the upper teens now, and it clearly makes profitability then hit the bottom line much stronger. I think a lot of dealers understand this and have felt this, and many of you have lived through this. On the next slide, though, it brings up a question that has really been bubbling out there for a few years, but has definitely had an uptick in the last couple of years, and that is, what about ag equipment dealers moving into the rental market? Is that a change in the economy that's just a fad? Is that a change in the economy that's kind of fleeting and will go away? Or is it here to stay? I mean, clearly there's a similar business model, to your related, I'm trying to find the right term. I guess it doesn't really matter, but
Brethren.
Yeah, your brother or sister, friends that sell construction equipment. I mean, clearly they have larger rental fleets oftentimes than they have in inventory. But there are some major differences. I'm going to be honest with you. You know that between ag dealers and equipment and construction dealers. We'll get to that here in a little bit. But during 2014 to 2017, we certainly saw an interest from farmers, from ag producers in saying, hey, how do I not have to buy these large pieces of equipment? Can I rent them? And many dealers were not comfortable renting. Many OEMs were not comfortable in having those types of programs. And so they said, well, we can set them up as a lease. And clearly, there were a lot of really good lease deals out there for the dealership. There were a lot of really good lease deals out there for the producer.
Most of them the latter.
Yeah, most of them probably better for the customer than the dealer. In fact, a number of dealers really got stuck as some of those really short-term leases that were only 1 or 2 years came back to really bite them when the piece of equipment was returned and they had residual guarantees on them. In fact, Mark and I were, I'm not even going to say where we were, but we were introducing someone else in our firm who works with producers to a referral we had gotten from the local dealership. Very large dealer, somebody we worked with for a while. And as we were making this introduction, our colleagues were talking with them about their farming operations and how it was going. And they were bragging to our colleagues about the great deal they'd gotten on a 1-year lease. And Mark, wasn't it a 1-year lease on a new combine? How much was that year lease?
it was under $20,000. And it wasn't a combine. It was actually more expensive than that. It was actually a cotton picker.
That's
So
right.
it was,
That's right. So for $20,000. So our colleagues were really excited for this farmer that we were talking with. Mark and I both glanced at each other and were like, how many of these bad deals has our dealership done? And not that they were bad deals. I shouldn't say that, because we don't know the other things that went on. That I can tell you they were a financially difficult deal for the dealer. Doesn't mean they shouldn't do it. But anyway, so that was 2014 to 2017. In the last couple of years, like I said, we've had an uptick in the number of dealers that have asked us, what about setting up some type of rental structure? And so we've done that with a couple of them. It really isn't that complex, but one of the things that I would say, without getting into the details of it today, is we have set those up outside of the dealership, which is very different than how construction equipment dealers do it. Usually they're inside the dealership. We've actually set up a separate entity. We've also had to work with them about being very careful about what types of equipment are going to go in there. I mean, clearly, if we're talking about a tractor that can be used year round for multiple reasons, that's one thing. If somebody's wanting to put a combine or a cotton picker, some other forage harvester, whatever in there, that's really only used several weeks out of the year and then is going to sit the remaining 10 months or whatever, that's not a good situation. That's not obviously ideal for a rental fleet. So that's really a major difference. Some of the pros here that you can see, though, in this first column, and things will start to appear as I talk. Clearly, by moving to a rental type of economy, if you're doing it outside the dealership, you can potentially get market share credit for it. Obviously, if you're selling to some kind of related party, you have the opportunity to have whatever kind of margin, depending on what the similar ownership is, on those sales to help the dealership. Clearly, knowing there's an offset on the other side can also help meet these mandates from OEMs as they've pumped out equipment and have a place for it. The other nice thing is, from a financial perspective, is one of the nice things about rental fleets, and our construction dealers certainly get the benefit of this every year, is with bonus depreciation, there's a lot of tax deductions that are then created. And so the metrics do become quite different, but it can create a lot of bonus depreciation for that. And when we have low interest rates, it's a good time to do something like this, because oftentimes there clearly has to be financing. Now, on the pros and the cons side of this, the con side of this is the way that this affects the balance sheet of a dealership could be quite incredible. It can use a lot of cash, and it puts a lot of debt on the books to do this. And so with the ones we've been working with, again, this is the entering maybe year 3 here. We've been doing this for a couple of years. They have been working their way into it and are building that fleet and doing it cautiously, as opposed to just, okay, we need to shove a bunch of equipment over there. The other thing that it does clearly is it's going to start to throw off a lot of the key performance indicators that dealerships are used to looking at to measure performance, or that OEMs are used to looking at to determine equity and turns and that sort of thing. And so it's only a con or negative in the sense of you need to be aware of it if you're going to do it. It takes a lot of planning ahead of time. Once you get in the rhythm of it, in the routine of it, again, construction dealers, this is their business. They are very used to it. And we have some very large construction equipment dealers. They might add $50 million to their rental fleet year over year over year. Well, they're also selling out of their rental fleet, and it becomes a very just a normal way of doing business. The concern here is many of these good things that we listed under the pros, though, we could also move over into the negative category, and that is, okay, are we just kicking a problem down the road or delaying a challenge? So all of a sudden, are we creating a used inventory glut? Because that's essentially what a rental fleet is. Are we creating a used inventory glut, and is that going to catch up to us like it did in 2013 or 2014, 2012, depending where you were? The other thing is, down the road, there are some tax things that have changed, that will continue to change. The biggest one is this: it says no LKE. LKE is an abbreviation that construction dealers are very familiar with. Ag dealers maybe not as much. It stands for like-kind exchanges. And maybe many of you have used like-kind exchanges on real estate, which is still allowed. But like-kind exchanges are no longer allowed on tangible personal property, which is what equipment is. Tangible meaning touch it, personal meaning not real estate. And so it doesn't maybe have the tax benefits that it used to when bonus depreciation goes away. But that's probably a little deeper topic than.
In fact, Clinton, do you suppose that those tax recoveries will happen at the same tax rate as we're paying now, or will these trillions of dollars we've spent do anything with the tax rate?
Well, I do not have time for that soapbox, but I can tell you this, Mark. In my working career, we are in the lowest tax environment I've ever experienced, and we're at the highest debt as a nation. I do not think that will be sustainable. So, but I'll save that for another presentation because I could talk for a while on that. Why don't you, Mark, the next couple of slides, talk about the age of the fleet. I'm going to check. We've had a couple of questions asking the Q&A. I'm going to check those and make sure we get to that
Okay.
when I wrap up after you.
Historically, ag equipment, we've looked at basically a 7-year cycle in the ag industry. The age of the fleet right now, when you kind of look at some of those lines and where they're going from the really old equipment to the newer equipment, it looks like it might be more of a 5-year cycle now, because you can kind of see the ins and the outs there. The used inventory on the lots, dealers did a really good job. Those have decreased, as has the used production rate, and that's a rate that Clint and I like to calculate a lot of times for dealers. Basically, how much of your new margin are you reinvesting into your used fleet, making you a producer like an OEM, but of used equipment. Those have also gone down. So the used equipment that was for sale seems to be somewhat in check. The used inventory in the fields and the barns, however, that has increased in age. The increase is a little bit confusing because we also see that the new number, the newest numbers, which is the blue line there, the 0 to 1 year, those are also increasing. And with mud deals not necessarily getting renewed, that might mean that there's some newer equipment that is still sitting in the lot that would have, or in the farmer's lot that would have been in yours after a year of a mud trade and things like that. People are keeping tractors much longer now. We saw the first quarter, first 2 quarters actually, the revenue from dealers was up about 14 to 15%. When you look through to that, though, most of that was service, and dealers made a lot of comments to us about we were servicing equipment that we had forgot that the farmer had. It was that old. It had gone off of our kind of replacement lists, and good news that we're fixing it, and even better news that we're fixing it, because maybe they are going to get rid of it at some point. With this graph, it's not as clear. We hear a lot of anecdotal evidence about the age of the fleet, but we hadn't seen any hard line numbers. I do have to stop a second and think, so from 2010 to 2019, I actually got this from Ag Equipment Intelligence. You need to note that 2019's wasn't December 31st, 19. It was actually after the first quarter of 19 when they were doing a similar thing that said, hey, 2020 looks like the greatest, it's shaping up to be a good year because of the age of the fleet. And then Casey Seymour at 21st Century and Moving Iron LLC, he gave me some data that I was able to put the graph together for the top line there, which was the June 30th, 20 numbers. This graph doesn't necessarily show us the age of the fleet that we're looking for. So on this next look, I did this more kind of looking towards, how about that equipment that's in its prime trading age? So that red line there of the equipment that is 3 to 5 years old. The blue line is 0 to 2 years, which again, that's increasing. 2006-30-20, we see a really big increase there. 18% of it is in that 0 to 2 years. Well, 2019 was a good year. I mean, we saw revenues almost get back to 2014 levels. It's hard to tell if they were really at 2014 levels because most of you did some kind of merger acquisition between 2014 and now, but with the inclusion of the merger and acquisition activity, most of the revenue was back to 14 levels. So it makes sense that we see that newer equipment there. But the thing that you have to start kind of studying is how long have we had equipment in the red and green numbers? And so if you go back and remember, kind of do a little detective work and say, well, 2012, 13, 2011 to some extent were our best income years that we can remember. What happened right before that? Because maybe that's what caused it. And that's where we kind of saw the run up in age of equipment back there. So we saw the red line, that 3 to 5 year equipment starting to get some hair on it. and it got traded then in those years. And so that looks to be like what's happening now. We see, basically starting in 16, we've had about 30% in that 3 to 5 year. Well, now all of a sudden we got 4 years of that. And so at some point, those farmers are going to have to bring that equipment in. So again, thanks to Ag Equipment Intelligence and Casey to help me put that information together. It wasn't quite as old as I thought it was going to be, based on what our dealers are telling us and based on the amount of used inventory that I'm seeing in dealers' lots, which is a good thing, but it is certainly got some age on it. Clint, how precision?
Mark, I might just, I was checking the time here. From a precision ag perspective, what I would say is I'm gonna let people read these slides to themselves while I talk here, but we're definitely seeing a different OEMs have a different amount of focus on this. I would say John Deere certainly is one of the ones more focused on it. They had really pushed for it in 2013, 2014. In fact, they had some mandates out there to their dealers about you have to be at certain tiers of integrated solutions and have so many of your customer percentage, you're going to be measured on this and incentivize that sort of thing. And then when the crash of 14 happened, that pulled back along with the other OEMs did as well. But we are seeing a renewed interest in it. There are what's interesting about it is I don't know that you could buy, again, from Deere, kind of who would have been on the front edge of this. I don't know that you could have bought a machine of any size since 2011 or 12 that didn't have the technology built into it already. Now the customer could decide not to turn it on or activate it, but it's there. It's kind of like a truck. You can't buy a truck without airbags. It just doesn't exist anymore, right? I guess you can't turn those off, or you're not supposed to pull that fuse. I'll say that. So in the interest of time, people have kind of given them enough time maybe to read the slide and look at the numbers. I do want to move us on to the next slide here. We've had a couple of questions come in I want to get to, and then we had a few questions even before that were submitted I want us to touch on. One of the questions that came in ahead of time, we were able to prepare this chart for it, is how has PPP affected dealers, specifically from a cash balance? And then we've got a couple of questions about the forgiveness side of it. Mark and I have done a lot of talking about PPP, although it's interesting, no one had asked us about the cash balance. And so we went back and looked through a number of our dealers in terms of their cash on hand at June 30th of 2017, June 30th of 18, June 30th of 19, June 30th of 20. And in the chart that you can see here, the green line would show, let me talk about the blue line, I'm sorry. The blue line would show dealers that did not receive any PPP funds. And so they were generally sitting on more.
Not by their own choice.
Right, not by their own choice. They were just too large. And so these are larger dealers that were over 500 employees. And so in 2017, there was a noticeable difference in the amount of cash on hand that they held compared to the dealers less than 500 employees, which are still big dealers. And so about in 2018 and 2019, in 2018, the two lines kind of come together, right? Get a little closer to one another. In 2019, they both kind of maintain. But then in 2020, we clearly noticed a difference here where the larger dealers that did not have access to PPP are sitting on the same amount of cash they had last year, which is also a good thing. It means they've been able to adapt to changes in revenue. They've been able to control costs. But for the dealers who receive PPP money, we've noticed a very sharp increase in the amount of cash they have on hand. And in fact, percentage-wise, on average, theirs went up 79%. 50% of the 79, 50 of the 79 is directly related to the amount of PPP loans they received, which on average, the dealers we looked at received about a $3.2 million PPP loan. But that also means the other 29 points of the 79 are from operations or from the timing of working capital and that sort of thing. There could be a number of things in there. Point is, a lot of dealers are cash strong right now, which creates opportunity for them to continue some merger and acquisition activity or continue some transition activity on their own. Mark, two of the questions that we've had come in earlier about PPP. One was, how how will the PPP loan affect taxes for planning? And then another one was, what are some factors that dealers should use to determine if they should request for the PPP funds to be forgiven? And I don't want us to get too bogged down on PPP, because you and I have done a lot of presentations on that. So I'm going to hit the tax one first, and then have you talk about the need and the access to capital components of forgiveness. From a tax perspective, right now, the PPP loan itself, even if you ask for forgiveness, is not included in taxable income. However, the IRS has issued a guidance out there, which I think is actually a good thing, where they said, just so you know, that also means the expenses you paid with that money are not tax deductions. And so basically, the loan is not excluded from income for tax purposes. However, clearly, I appreciated the IRS. I don't normally say this, but I appreciated the IRS, Mark, in making that clarification, because it did cause Congress to act and say, wait a second, SBA, IRS, that was not our intent. Our intent was to get PPP money into the hands of business owners. It's called the Paycheck Protection Program. So they could keep people employed, and they don't have to pay taxes on it, and they still get to get those tax deductions for the things they did pay with it, primarily payroll. And so the IRS and the SBA said, well, if that's the intent, then in your next piece of legislation, you need to clarify that. And what I would say is there is support on both sides of the aisle for that provision being put into the next economic stimulus package, which they're debating or they're building as we speak, shall we say. So right now, for planning purposes, if you wanted to be ultra conservative, I think what you would say is, hey, if we get this forgiven, basically, I'm either going to have to pick it up as income, or I'm not going to get to take the tax deductions. The math works out the same way, but that's ultra conservative. To me, the right answer is you're still going to get to take your tax deductions, and you're going to get to exclude this from income. Because that was congressional intent and congressional support. For more on that, clearly reach out to us. We can dive into that, as we have with a lot of dealers. Mark, what are the top two things they ought to think about when it comes to loan forgiveness, and where the SBA's threat of auditing all of these loans might be relevant?
Yeah, when dealers call and ask, I get questions every day, but it's usually around, are I going to get in trouble because my revenue isn't down? My profits are up. What happens if I still look like this at the end of the year? Are they going to say I didn't deserve the loan? And the thing that I keep reminding dealers is, you need to set that aside. You need to go back to, what did we think in April when the corn prices did what we showed, when the ethanol tanked, and when everything looked like it was going to be bad and it was going to disrupt that nice year we were already having and erode all of our profits. That is the point in time that that's when we asked for the PPP loan, and that's when the determination was made whether or not indeed we deserved the PPP loan. If your loan was under $2 million, the rule basically says if the bank gave you the loan, then you deserved it. If you're over $2 million, that's where you've got to maybe build your case about, the year turned out better than we thought, but back in April, we had every reason to believe that it was bad. When we switched from 8 weeks to 24 weeks, I don't think I got a single dealer that's concerned about spending the money. Algebra just works in your favor. There's no way that you could have got a loan on 10 weeks worth of payroll and not consume it all in 24 weeks of payroll. And so from that perspective, I think that all looks good. So should you ask for forgiveness? Heck yeah, the program was designed for that. When you ask for it, might be that might be something that there's some strategy involved in. If you've got a year end other than December, and to Clinton's point on the tax thing, that hasn't gotten fixed yet, you might want to hold off filing that tax return and/or asking for forgiveness yet to make sure that is going to be deductible and you don't have to amend a return and those kind of things. So there's certainly a lot of strategy about when to do it. Luckily, the SBA did announce finally that August 10th, there is a mechanism for the banks to start actually processing those, but not before. So that's the biggest question we get all the time is, when can I actually do my forgiveness application? So
well, and Mark, I've even seen things from a number of banks sending information out to customers of theirs and / customers of ours saying you might want to wait also for advice. So even the banks are on board. I've got a couple other questions here, Mark, that before we do the last slide here, that I wanted to read for the group. One of them came in earlier. It was what was the future next 1 to 3 years of ethanol. I think you shared with that. It's trending clearly with oil prices, which are still on a downward maybe short-term stabilized trajectory.
Well, and even long-term wise, even if oil is not our energy source of choice, it could mean that doesn't necessarily mean that ethanol goes down. In fact, they can put more ethanol into the gas we're using and use even less oil. So we'll have to see how that looks like, but certainly ethanol could change.
Correct. Yeah. A few more questions have come in. One is there a bigger need of multi-brand diagnostic tools for agriculture machinery? You know, I think anytime the economy tightens up, customers then start to look for ways to save money. And maybe it's, yeah, I've got this piece of such and such equipment, but I'm not necessarily going to go back to that dealership. And so I think, you know, I assume that's what this person's asking about in terms of a multi-brand diagnostic tools. I think those will increase, or the need for that will increase. The couple of questions about our practice specifically, Mark, you know, do we work with all different OEM dealerships or a specific one? What I would say is we definitely work mostly with John Deere dealers, ag dealers, because of their size and need for our services. But we also work with some very large case dealers, New Holland dealers, Bobcat dealers, Cat dealers, John Deere Construction, Komatsu. I mean, that's the nice thing I think about having a nationwide practice is you're able to work with a lot of the different ones that are still in the same industry. Jared had asked, do we offer leadership development and training as part of our services? We do, yep. And what I would say is Mark and I would love to have that conversation with anyone interested in that. Another question here, are you seeing dealers having issues with sourcing equipment due to OEM manufacturers shutting down from COVID, or is there equipment available? Might get two different answers from me and Mark. What I would say there is I've still been hearing from a new perspective. There's still a lot of new equipment out there. Certainly OEMs did scale back earlier on. And so I think that was a good thing. I don't think there's a glut of it, but there's still a lot of new equipment out there. From a used equipment perspective, it's funny. We have dealers who some have a glut of used and are trying to get rid of it, and others who can't find enough of it and are buying it everywhere, even in some cases buying it from the lease returns that went back to their OEM. But I don't know that any of that is COVID related. Have you seen? I mean, that we
there are some with there's some specific models with some specific dealers that we're going to run short on this year. In fact, I've had a couple of dealers concerned that they're not going to be able to meet their lease obligations. The farmers that they promised that yes, you can lease something, because they're afraid they're going to have to take it out of their for sale fleet because there's not going to be enough. And that's most of those are around some of the bigger row crop tractors that there might not be enough of. So again, it's specific models. And to your point, earlier, the OEM mandates on ordering equipment have changed a lot, such that a lot of the OEMs are requiring that you have 6 months in the lot, 6 months on order, and 6 months on backlog, that kind of thing. And so there's a lot of inventory already spoken for before they start rolling out the door. And so when they shut down the factories for 2 or 3 weeks at a time, that some of them did, you know, that is going to have some impact on certain models.
Yeah, it makes your turns hard when you have to have 6 months inventory on the lot and 6 months ordered.
It's hard to get past too.
Mark, why don't you wrap up? This next slide, I think, is our last slide of content.
Yeah, you know, on here, I think the point is the 2020 different dealerships, different results. Whether where you're at, what brands you carry, whether there's supply issues, whether there's whether you've got more of a bent towards small ag and turf. Those kind of things. There's different dealerships are going to have different results. I think historically we've always had opportunities and challenges go up. Got some quotes here from some guys from important to our history that have some quotes on here. But you know, Albert Einstein said, "In the middle of difficulty lies opportunity," and that's what we're at. We're in difficulty right now. Find the opportunity and then don't give up on it. Some of the stuff that you've done differently this year is great. Keep it up, even if the life returns to normal. Thomas Edison also said, opportunity is missed by most people because it's dressed in overalls and looks like work. And I think that's what this year, that's back to the back to the chopping wood comment for our dealerships. If they do the right things, continue to focus on the long-term strategies, look for new ways to make money, those kind of things. I think those dealers will be in good shape. Henry Ford said, when everything seems to be going against you, remember the airplane takes off against the wind, not with it. And so you can also rise like the ultimate airplane. And then my favorite business philosopher of all time, Chris Farley, to his point about challenges, the point is, how do you know the guarantee fairy isn't a crazy glue sniffer? And so you can always appreciate Chris Farley, but yeah, there are no guarantees. You guys are business managers and business owners for a reason. You like the challenge and you like the opportunities. You just like the opportunities to be bigger than the challenges, but there's no guarantee it's ever going to work out, and we'll get through it. So with that, that's our presentation. I don't know if you've got any more questions for us. We got to all of them, but we'll turn it back over to you, Ben.
Mark, I might just, before we turn it over to Ben, what I might encourage people is if you don't currently get our stories from the road, that's about a 5 or 6 minute video that Mark and I produce literally when we're on the road, although our last few months we've had to do from the office. Check that out. It's a great way. A lot of times we'll mention things that Ag Equipment Intelligence is doing in those as well. It's a great way to stay informed. Ben, there is a question about will the slide deck be available for later review? But I'll defer that to Ben, and also thank you guys for letting us present today.
Thank you, gentlemen. The presentation will be available for playback later on the site to answer that question. And that is all the time we have for today. So I want to thank everybody for joining us. You can watch your email in the Ag Equipment Intelligence newsletter for more information on the replays that will be available on the site. On behalf of Mark Johnson, Clinton Baker, Coe Isom, and the staff of Ag Equipment Intelligence, I'd like to thank you for joining us today. When you leave the webinar, you'll be directed to a short survey. Please feel free to reach out to let us know what you thought of this live event and what other topics you'd like to see in future webinars. Thank you again, and enjoy the rest of your day, everybody.